today we have something actually a little bit technical. So, but I think this is a very current topic in finance as well. And we need to understand probably how the development in advanced technology like AI, large language models, how can they be applied in finance? So as you can see that the title is a little bit different. It looks like different from the title that we advised in our emails. However, the direction, the research, the nature probably is very much the same or similar, let's say. So today we have Professor Jing Chen, Maggie, who is going to present their new actually research. And Maggie is actually has been a professor in financial mathematics. I just understand that it is in Department of Mathematics, which is, you can imagine, a lot of, financial engineering things. And obviously, Maggie has been researcher to provide a kind of technical foundation for people who are working in finance in terms of modeling, mathematical or recently AI and large language models. And in finance, of course, we have a lot of areas where we need to use this type of application, particularly for volatility modeling. And volatility, as we know that is everywhere in stock market, in bond market, in now a commodity market, but now the new types of financial assets, cryptocurrencies, and all type of that. So as you can see, Maggie has been leading quite a few very big projects. So I'm not going to read each of the project, but as you can see that the application of mathematics or AI, large language models in finance is very popular. And there are a lot of demand, for this type of modeling so that we can improve forecasting, we can improve measuring or modeling volatilities in financial market. So without further ado, I will give the floor to Professor Chen. And I think our audience, Maggie, today is a combination of different backgrounds. So some people, they have a finance backgrounds. Some my colleagues, probably they are from management, business, or some other interdisciplinary. So I hope you will be gentle in presenting, I'm sure. So the floor is yours, Maggie. You can start, please. Yeah.
Thank you, Bo. Thank you for the kind introduction. Don't worry, I'm trained as a financial economist. That's assurance. So it's quite a journey to work with my math colleagues. But the most work, we do here is trying to make complicated things simple and accessible. So although you will see the formulas and stuff in my slides, but we're not going to go into the math details, but instead I try to explain how we use that. So, if you just turn your head, AI or large language models is everywhere. And the question is just as what I wrote here, for the classic finance problems and volatility forecasting, will the traditional model work, or we actually have to just jump on the bandwagon of AI and LLM? So this is a PhD project that my PhD student Beining Han is doing, and Dr. Antilio and myself are the supervisors. I think they may be here today as well. Anyway, so we will see how it goes. I'm currently leading two big EPSRC grant projects. One is called UK Thing. That's a consortium which aims to bring the researchers to work with industry to solve the real life problems. So you could look up the UK Thing and see what we do. And another big project is funded by the government. It's called AI for CI. It's AI for collective intelligence. So the whole idea is how we use AI to solve the real data, real life based problems. So I hope I showcase that today. This is the plan. I will go through the quick background and then explain the existing work. When I talk about existing work, is that the work you advertised. I say it's existing because it's published. So, but I want to explain that line of work, and I also want to explain what's happening after we publish that paper. That's why I changed the title. And then they introduce some machine learning models and some AI models, and just to compare them with the traditional models, and then say, to answer the question whether, for the classic finance problems at the moment, do we really need AI to do all the work we are very familiar with? And please do ask questions while I go along. I'm also very happy to take questions at the back. So whatever fits the audience would be good for me. So background. Okay. We look into the Bitcoin market for a very, very simple reason, data availability. So, of course, the methodology would be, could be adopted to look at, bond market, stock prices, just that in the math department, we don't really have, access to, Bloomberg, etc. So we tend to work with publicly available data, or we generate our synthetic data set. So that's the initial reason. But another reason is that crypto market is no longer kind of something new to us, especially for researchers. So you can see that I have a couple of plots just to give you a bit idea of why this market is very, very important. So the top left is showing the number of cryptocurrencies worldwide, since 2013. So pretty much you can see that year on year, there are loads of new different type of cryptocurrency coming into the market. But of course, a lot of them die. But nonetheless, this market still, develops very well. And today, the middle part of this, this kind of figure with a black background with the yellow kind of line here is showing the market cap of the crypto market. So in May 2025, the market cap is already kind of exceeding 2 trillion. In July, at some point, it actually exceeds $4 trillion. But there, of course, there are questions about, how is it working? A lot of cryptocurrencies like Bitcoins, will be soon be fully mined, and what's going on there. But however, in terms of currency markets, there are a lot of, standing questions. But in terms of investment vehicle, we just can't ignore this market. You have plenty of volume, liquidity, price movement, and market value, market cap there. And the bottom one, this is a list. It basically just a quick snapshot of the top 10 cryptocurrencies by the market cap. And the idea is that Bitcoin market is so far still the most dominant crypto, and it is the first kind of cryptocurrency. And the main thing is the technology underneath, blockchain or cryptography, is not going to go away, at all. And the people still will see strong value in technology itself. And plus the investment side of value, this market is really prospering. And if you're looking at now, this market, we're talking about over $2 trillion market cap. And it's very highly speculative and volatile. Even within last week, when Trump had a policy change or say something in the public domain, market crashed one day, bounced back another day, and then crashed again. So you can clearly see, as a finance researcher, you possibly will think, wow, the volatility in this market is crazy. That has generated a lot of speculative opportunities in the market. Therefore, there are lots of interesting things that we are very familiar with. For example, price discovery, liquidity issue, risk. All these things, would apply to this market and will draw a lot of interest in this. So in this graph, the middle one is showing the closing price, the price trend of the cryptocurrency. So the bottom one is giving us the histogram or some statistical property of the time series we're familiar with. This is Bitcoin closing price. What we can observe here is that from the market observation, we know the market itself is very highly speculative and very volatile. But if you look at the histogram or the distributional features, the market, the distribution is incredibly symmetric, but it's not a normal distribution. And what we also found is that there are a lot of extreme events happening in the market that can be explained by the statistical properties. If you look at the distribution or the histogram here, the very bottom, left bottom, you can see that the tail, the distribution of the Bitcoin returns have very long, very thin tails. And that tells us, the kurtosis of the time series is very large, and it's a very specific type of kurtosis. It's kind of hyperbolic tails, this long, thin tails. It's very different from like fat tail events we're familiar with. So that also possibly draw a lot of interest for the researchers to look into this market as well. And also, we now know, it's very, very easy for normal people to access trading. So there are lots of social platforms, and, people make a tweet or post something on Facebook that will affect how people view the market. And also there are lots of trading apps that, for, say, a young person, if they know nothing, they're just simply interested, they can register an account and then start trading Bitcoins, etc. So with all this, it's possibly not kind of unfamiliar that this market, has a lot of sentiment or momentum. Those kind of phenomena that's closely linked to the behavior side of things or cognitive biases. And here, we just quickly look at a few sentiment indicators. So the top one is the the Google search. So it's basically Google counts, which plots the how people search Bitcoin as a keyword. You can clearly see the pattern is very much like the noisy time series return or price series. And the middle one, the green one, is the fear index. That is a typical sentiment index we all use to look at the market mood. And you can also see that, in this market, the sentiment fluctuates quite a lot. The final one, I think this is not, need to make it bigger. I couldn't see. Sorry, the top one, I possibly said it wrong. The top one is a simple count of the Bitcoin. Bitcoin mentions. The second one is Google trend. The bottom one is actually fear and greed index. The point here is that, if you look at the sentiment indicators or simple sentiment indicators we know or that's available in the market, you can see this market has a lot of fluctuation as well. So for volatility forecasting, we're very familiar with, using the volatility model itself, but in recent years, and there are also large literature to say the market is not only just driven by the price movement itself, sentiment plays a very important role to affect that volatility as well. So this,
Maggie?
Yeah.
Yeah. At this moment, Maggie, can I ask you a question so that we can lead the audience to your next the modeling thing? So you showed us a lot of pictures and to show that this market, you use Bitcoin particularly, Bitcoin market is more volatile. So people with some finance background, we have seen the similar pictures in terms of the stock market, the index, and maybe the bond market as well. But can you talk a little bit more about the differences between this crypto market and our familiar conventional elements of the financial market in terms of the sentiment, volatility, and whatever. So if you can talk about the differences in a comparative way so that we can make more connections. Thank you.
Yeah. Okay. So basically, when Bitcoin first designed, the design nature, basically it was designed as a currency. So when we look at for example, the Bitcoin prices, we would hope, it's a cryptocurrency. Somehow it is a currency. It should behave more like, say, dollar or pound.
Mm-hmm.
And the price trend, or if you look at the returns, it should kind of show some kind of currency features. So we wouldn't expect such great kind of fluctuation. We would expect volatility, but we possibly wouldn't expect the volatility, goes so crazy, fluctuates so fast, and also, exceeding very extreme bounds. That's the first thing I want to say. Comparing to the traditional stock markets or bond markets, if you look at the Bitcoin price itself, let me see. If you look at the middle one, the price trend, we possibly observe quite a lot that the actual Bitcoin price movement behaves more like a very liquid stock. So, for example, popular stock like a Facebook, like a Tesla, or this kind of we call Magnificent Seven. This is seven giant tech company like Meta, Microsoft. We would expect it behaves actually more like the very liquid stock. Like everybody wants to have shares in them, but they may be very expensive, and everybody's talking about them. So this kind of constant search attention on Bitcoin is very much like, people talking about, if you tell people, oh, do you know, say, a pharmaceutical company, possibly nobody heard about them. But if you say, oh, do you know Google? Everybody knows Google. So if you want to invest, those familiar names come to your mind first. Then when we observe the returns or the risk profile, like volatility or prices, the Bitcoin itself is very much like one of those very popular kind of stocks. The sentiment part coming in is also because of the attention. So, for example, when we teach students sentiment, we use a very typical example of Elon Musk tweeting about the Tesla. So every time, obviously this is fairly old story. So every time in the past when he tweets something about Tesla, on X or on Twitter, you can see the Tesla price immediately respond to it. So we see those kind of hypes in Bitcoin prices as well. That is not really driven by, for example, fundamentals that, the price go up and down. It is very much driven by the social attention. We call it sentiment or investment attention. And also if we observe even deeper in the market, you can see, like, for example, just a simple growth of the market, if you look at the top figure here, all the blue bar shows the market capitalization. You can clearly see in the recent years, this market just attract a lot of attention. It's very popular and it's just suddenly grow very, very fast. So all these things are pretty much can be viewed as something, well, just see it as a very liquid and a very desirable, very popular investment vehicle. Does that help a little bit?
Yeah, that helps a lot. But what I'm thinking about, they are different. So Tesla, yes, the stock market reacts immediately after they saw something on X, for example. But Tesla has physical assets. So Tesla is involved in the real activity. Bitcoin, for example, on the other hand, does not have the real thing. For me, is all sentimental driven rather than there's no fundamental. I cannot see the fundamental here, at least. Yeah. In addition to that, cryptocurrency is out of the regulation. Most of them probably are still not clear in terms of regulation. So there are high uncertainty involved for people who invested in this. And this is at least the bubbles are there still in Tesla, in some other tech firms, but they are connected to the real activities, the real economy. So how do you explain this? Can we say it's all bubbles there? Or the sentimental is the thing that is actually leading the market rather than anything fundamental?
Okay. Actually, that's a very interesting question. I think, there'll be a lot of ongoing research on that. So first thing I want to say is that we definitely know the Bitcoin now, if we observe how Bitcoin behave in the market, it's more of investment vehicle than the currency. Okay, for currency, we definitely will need to know what's the fundamental. That for example, dollar is backed up by the Fed's reserves, right? So as rightly as you said, it's not linked to any fiat currencies. It doesn't, it has a very limited supply, but possibly infinite demands. You never really can say it works as like equilibrium, like the economic equilibrium. But if we just look at the investment side of things, it possibly can achieve temporary equilibrium because depending on the current demand and supply in the market for Bitcoin as an investment asset, not the real asset. But another main thing, it is a kind of sentiment driven. The sentiment driven is also very different from traditional markets. In a sense that, people's view on this is divided and you can't easily say which one is right and which one is wrong. So for example, if you say, okay, this thing is just like no fundamental, no underlying stuff, why do I believe it? You will have a camp to say, no, but we believe fundamentally, it is built on the blockchain, and or some kind of fundamental technology. They believe in technology, and also people believe in the prospect of technology. That's a very legitimate argument. But on the other hand, people will say, no, it's just a hype. So for example, a lot of people get into this market. We did some research a couple of years ago to show that, 85%, more than 85% of the volume you see traded on the market day on day were actually artificially fabricated. And you will have a very tiny portion of Bitcoin traders possessing majority of the volume. Basically, you're having less than 1% of this we call Bitcoin trading sharks. They trade almost like those, like a big hedge funds. They manipulate the market, take up all the liquidity. But But because, as you said, this is a decentralized product based on the blockchain, it's so easy to access. You will have a lot of people easily access this investment. And people, for example, can be driven to invest and trade this simply because they fear they're going to miss out. It completely deviates from our value positions. It's in the past, you think investment, I have to know something. At least I need to know the risk level before I do something. But now people could just chase the hype, to fear to miss. So that's why this is quite an interesting market. But all in all, I think you actually helped me with my talk. It kind of, maybe I'm very safe to say it's worth looking at whether the market is driven by sentiment. We can't just simply believe, the volatility is like coming from the price movement itself. There will be some other signals affecting the volatility. Okay, let's leave it there, and then we move on to the rest and see how well
the volatility part. Yeah, please, thank you.
So I want to talk about the first project we did. We basically asked a very simple question. Can the machine learning model be better than the traditional forecasting model? So traditionally, we use a lot of GARCH model to either measure the implied volatility or do volatility forecasting. We can have the hack model, stochasticity, autoregressive model to look at the volatility forecasting. That's what we are familiar with. And then if you're in finance, or if you are not in finance, but you know a little bit about markets, you possibly heard of VIX, which is a volatility index. But all in all, those things are giving us some indication of the riskiness of the market. It's using the volatility to look at how risky the market is, and people are obsessed to get the better volatility forecasting. That's the traditional way. But obviously, when the machine learning model comes in, we know we have a better technical capacity, and we also have possibility to make it much more dynamic rather than static. So in the past, if you use a traditional model, you possibly have to have all your input into the model and have a static output to say what the forecast is like. But we want to know, when your time series is moving along, can my forecasting just automatically moving along as well? Just keep updating information and keep generating forecasting. So that's a very simple goal. But when you come to the machine learning model, you can have all kind of machine you want. And our original inspiration is very simple. We don't want to completely ditch the traditional model, because practically speaking, if you go to a bank, you say to them, okay, I have this new machine, just use this, get rid of all your GARCH model based, risk models. It's impossible. People will not buy in that. We are literally doing those in ivory tower. You don't find real application. So we want to use what we've already got. We also want to see whether we can make complicated things simple. So we come up with this idea. Obviously, in the literature, there are lots of literature using GARCH models. There are lots of literature already tried to just use LSTM, the long short memory machines, see whether it can replace the GARCH to do the forecasting. There are also people in the middle to say, okay, I combine them. So we basically took the combined version. So we want to use GARCH. We also want to use LSTM. What we wanted to do is this. What we wanted to do is that you will have, I think maybe it's easier if I explain the model structure this way. So basically, what we wanted to do is that this is one single layer, long short term machine. That's a typical machine learning model we see used in the literature to forecast volatility. This is the structure. So on the very left-hand side, where I mark with batch size, etc., you can think this is my input end, okay? And then you have I have input coming into this this batch structure here, and the machine, then they capture the features of the data and then put it into my machine, this LSTM machine, and then it will generate a forecasting output for me. This is the structure. So what we did here is that we thought, okay, you know, if we want to know what's the volatility of Bitcoin market tomorrow, the best thing we can rely on is what's happening today. What we are using here is that we use the traditional GARCH model that's used to estimate the volatility. And we fit the GARCH model. There are different types of GARCH model here. You have a typical GARCH model called GJR GARCH, T-GARCH, E-GARCH, or basic GARCH. So what we can do is that we fit the GARCH model at the time T, and then we can see how each different GARCH measure the volatility at the time we're looking at. Okay, and then we will see which GARCH volatility at the time fits the empirical distribution the best. And then we pick that the best input and put into our machines. And then the machines can learn or grab the information from what we have fitted to produce better output. So idea here is very simple. If we have the better quality input, then we'll put it into a black box machine, and you can tend to, we expect to have a better output. So that's the whole design idea. So when we did this input, basically we are letting all different types of GARCH are fitting at the time T. And then we grabbed the most fitted one and put into the LSTM machine. And LSTM machine is basic. Within the machine, you will have optimizers to optimize that volatility forecasting process. And then we tidy up the output from LSTM through this condensed layer, and then generate the forecasting outcome.
And Maggie, so when you say you are fitting all the different types of GARCH models,
yeah,
you do not use large language models,
no.
Right? So you do not use AI. You use historical data to, like a traditional way of doing GARCH models.
Yeah, absolutely.
And then how do you identify which one is the best one?
Okay. You already asked ahead. Great. So maybe this is the...
No, I'm talking about the input now. So I know there is an optimization process in the second stage, at the second step, but for your input, you need to have... you said you needed to input the best one. But how do you select the best one? And how do we know them?
At any time T, you will, and because it's based on the historical data, you will already get the whole series, the distribution. You can also obtain the empirical distribution. So basically, at the time T, what the GARCH model generates, shows the best fit with your current empirical distribution is the best. So for example, this is the fitting kind of results we got. Just a snapshot, across the entire sample. You can see the red one is GARCH 1.1. It's and the black one, the very dark black one, which you may or may not see, that is implied volatility index. It's published by T3. We call it T3 index. It's basically calculated based on the option pricing. So that is a risk neutral measure. And you can clearly see the GARCH 1.1, the red one, doesn't really show any kind of fundamental value or the risk neutral value of that. And you also can see we fitted different GARCH model by varying the distribution as well. So, okay, put it simple, we fit and we pick up the results that have the best fit with the empirical distribution. If you there are various statistical diagnostic tests you can do to show which is the best as well. So, for example, you can look at the goodness fit kind of stats that tells you at time t which one is the best. So basically what we're doing is to kind of make the input side better and put into the LSTM, and then the LSTM would do the optimization basically. Within the LSTM, what the machine does is you can see that the machine will take all the information, historical information, which is the C gate, the CT -1, that's the cell state. That means all the past information. Okay. And we will also have our input gate. That's the new information coming as at time t. This is the I gate. Where is I? Here's I. And basically what's already in my machine, the historical data, and then at time t, I have any new information updates will come into the machine. And it goes through the NT, which is basically operators here, that has a loss constantly calculated loss function or doing the optimization. And then come to, then after the optimization, it gives me the output through the output gate of OT. But obviously, my machine has a certain capacity, and while I incorporate new information, I will forget the old information that is no use. So that's why you also see there is F gate. FT here is a forget gate. So that's how the cell works in the middle. I mean, if you're not a computer scientist or you're really kind of more interested in application, just take this as the machine basic inside is getting rid of not useful information, incorporating new information, doing the optimization to get output. Okay. And if we can go through the some real example, it's possibly clearer. So what we basically use is daily closing price, the Bitcoin price against the US dollars between 2019 and 2023. We also pick up the Bitcoin implied volatility index, which is industry standard volatility index for Bitcoin. As a kind of, kind of benchmark. And we then, what we did is we fit the GARCH model to be input. So every time we put into input, you can see here, we put input in and input keeps coming in, and the machine pick up batches. And then to learn from this and to train the model. And that whole process is recursively happen in the entire machine learning models. And for the machine learning models itself, because I have optimization going on, and with those information gates, forget gates, etc., and operators or optimizers. So main thing is to do the hyperparameter tuning. So based on your data and machine setup, and also in terms of, if you use a standard machine, it has a standard optimizer. For example, here we're using Adam optimizer. We didn't really create out new, and it will find out what parameters are actually significant parameters that will make your machine optimization converge to get output. And after many rounds of, the tuning, we basically found these are the main hyperparameters that's useful. And obviously, when the hyperparameters does this work, it's usually search the entire space. We call it global search, and then come up with a range. For example, every batch I can input 8 observation or 16 or 32 or 64. Through the global search, we find out the range of where the parameter sits. And then you do the local gradient search to find out exactly which is the best parameter value that gives us the best outcome. Okay, so this is a typical machine learning training process. And you can see that the important parameters are the typical parameters. So for example, how fast the machine learning algorithm can learn. And, if you need to set up a threshold, for example, you're learning, and you can't let the machine keep running. The machine has to have the ability that if you run for a while, knows that it doesn't converge. I need to come out of the loop to retrain the model. So that's very standard. Anyway, we did all this, and this is our results. You can see we have this industry volatility benchmark. That's basically like the VIX in S&P 500. This is the VIX for Bitcoin. That's the blue line. And you can see our volatility forecasting using traditional GARCH 1.1 or GR GARCH or T GARCH or E GARCH. And the purple ones are fitted GARCH LSTM machine. Well, it's kind of a lot of lines here. It's quite difficult to see, but the one thing you can see is that the orange line or the red line, it's basically, apart from this purple line, which kind of coincides with index benchmark very closely, but the rest tend to exaggerate. It's either sitting well above the blue line or well below. And sometimes misses the spikes. So this is a visual display of our results. Then we thought, okay, we get some stats to show whether what we saw is correct. So we use the typical, RMSP, or RMSE, the root mean square errors for robustness check. So what we then did is to look at both in sample and out of sample forecast errors. You can clearly see that this new combined machine learning methods is better, in terms of reducing the forecasting errors. Yeah, so that's the first project we did. We also did a 5-day. Again, it's quite good. I just wonder whether there are questions, or maybe I just move on. Are you on mute?
Yeah, maybe we can see how my colleagues are doing, whether they have some questions at this stage, and that will be very good for us to follow you further. And do we have any questions at this stage? Yeah, so I see Anna. So Anna, hi, good to see you here. So Anna, you come in, please.
Sure. I just have a question, which I am not even sure if it's the correct question or not, but it's basically, my question is this. For everything you've done, could you also use Bayesian statistic with all of these?
Not in this project. This one is not as complicated as that. Like when we did the search, we literally used the basic standard method. No, we haven't done the Bayesian search. I think what you're saying is definitely a trend in the literature. We just haven't done it in this one.
Yeah, sure. Thank you.
Thank you.
And do we have more? Yes, we have Tulu here. Tulu, please.
Yes, thank you, Ong. This goes back to the earlier question that you asked. I'm not sure if she's still going to get there. I wanted to know whether and how she did features importances for this particular model, so that we can know the variables that are actually, apart from the hyperparameters that you have shown, those variables that are actually contributing to your predictions.
Maggie, it's okay if we ask Tulu to repeat his question.
No, I was just trying to see. I'm not quite. I don't quite understand what you mean. The variables contributing to the model.
Yeah, when you run a machine learning program such as this, there are a number of features that enter into your model. Okay, it's just like your typical regression. The coefficients will tell us the importance of the variables. So my question now is that given that many of these machine learning algorithms are black boxes, is it possible for you to tell us the variables that are motivating or influencing your results? Apart from the hyperparameters that you have shown, what are the main variables?
I got what you're saying. Yes, thanks to the. No, the input is only there's only one input. That's the implied volatility estimated from different GARCH models. This is not a regression model yet. When I move to the next one, I have multiple different inputs. The parameters, the hyperparameters, is from the machine itself. It's from the optimizer built into the machine. It's not actually the variables. These are very much to do with the mechanics or architecture of the machine. So, for example, the batch size. When here, in terms of features, well, there's only one feature. Well, multiple features. The features are all these different GARCH inputs. So each GARCH input is what we call one feature.
Okay, that goes back to my question.
Yeah.
If these are the features now, which one are the most important? And that implies that you have to show the feature importances of the model.
Yeah. Okay. Yeah. So for any time, we fit all of them in, and then what will be picked up would be the one at the time that is closestly fitted to the empirical distribution of the volatility at the time. So only that will be picked up to be put into the actual machine. So not all will be in the forecasting process. So for example, maybe at time t, I have t GARCH. Maybe next timestamp it would be e GARCH. But from the fitting results, we generally t GARCH is the most of the time is possibly the one that gives us the closest fit.
Yeah. So, Maggie, I have concerns about this part too, and I understand where Tulu is coming from. So, I understand that, Maggie, you introduced the application of AI and machine learning and to improve forecast. Particularly, based on this market data you take from this market. But then your input is all based on the conventional forecasting model, volatility forecasting model. And you did not give the machine everything that we observed in this market. You actually filtered a best model, which is basically the result that you got based on a lot of theoretical assumptions. In fact, you are criticizing the qualitativity of using those traditional volatility forecasting model. And then you use the traditional ways, you filtered a best one, and you feed the machine by those best results based on all the conventional volatility forecasting. So I want to ask you, of course, our economic things are in your traditional conventional volatility models, but not in the machine part. So I'm thinking, what is the contribution I mean, for this part, maybe the next part you will have more. But for this part, what is your contribution, and how do we see the improvement? You are improving not based on the original observation. According to the machine learning problem, the large language machines models, they should use much more observations than the observations that we already filtered.
Yeah. Okay. So first of all, I'm not I think, so traditional model basically, how can I say, the best contribution of this, the input side is obviously controlled. The output side, what we're saying, this biggest contribution is that when we have this machine, it's automating the forecasting process. So it can just keep going on. So if say I put machine in, the machine, it just keep going, it just keep forecasting. And also it's a dynamic approach, because whenever my input changes, my output will automatically forecast again. The traditional model also use one input, right? So for example, the typical HAC model, hack model is very much kind of, I mean, just despite all the technical side of things, whether it's a jump or not, let's just say it's pretty much kind of autoregressive type model. Yeah. So this is exactly doing that type. Idea is the same. I'm just using the machine to automate that idea. So for example, every step I move forward, the machine is going back to refactor the latest input and feeding in, learning again, to forecasting the full output.
Okay, I agree. It is better than the results we obtained from the conventional volatility models forecasting. So in that sense, your forecasting by adding machine learning is more accurate. And as you show, your model performance indicators are better. So yes, before I give the floor to other questions, can what you have been showing here, can this let's say approach be applied to conventional stock markets?
I think yes, definitely. And you see here, I didn't go to a lot of in the paper we discussed quite a lot. Here I didn't. So another good thing this one is that we don't really because we keep updating the input. That means when you're doing the forecasting, you will have enough data points. Always have enough data points to enable your output. So we actually don't really need to use, for example, high frequency data. I know high frequency data will have different features, but one basic point of increasing frequency is to increase the data sufficiency. Okay. So what we're saying here is that, we basically when we use machine learning models, big advantage is to enable this not autonomous, but automation process. So you can keep going, and it's more of a dynamic model. If you use a traditional hack model, every time you have to rerun the model, this machine, it just recursively rerun everything. And also from input side, this more combined model is basically mimicking a one-dimensional, like a univariate model. So when you talk about multiple outputs, you're basically talking about multivariate, say, volatility model. That's in the next project. Possibly it's more like that.
Yeah.
Yeah.
So this is one variable time series. Yes. So I saw Yana. Yana, do you have a question? I saw a hand before.
Yes, it is. It was true. Yes, it just.
Please,
I mean, bit naive. It would be nice question, but when you do a out of sample forecasting, you report the one day result. But I was wondering if you take a bit longer time period.
Yeah.
How the model will be performed. let's say 3 months, is the ability to even indicate anything in a slightly longer period. Although you're talking about high frequency data, I'm expecting that is this very, very sort of minute or tick data.
Yeah.
Then, well, when we talk about the model performance, out of sample model performance, I suppose we might need to think about more than 1 day. What do you think? I mean, is it?
No, very legitimate question. I got what you're
thank you.
So first of all, we use LSTM machines because, again, we're focusing on the application. We use what's being using in the literature particularly for like volatility forecast for like a stock type of asset. We're not thinking of, say, exchange rate market, for example, or some kind of long-term economic forecasting scenario. I don't think, to be honest, I don't think LSTM machines will be the best machine for economic forecasting. That's the area I'm not familiar with. So we took this is because it's typically used for this kind of very liquid asset, like liquid stock type of forecasting.
Yeah, but I'm sorry to interrupt you. I mean, if I am a hedge fund, or if I am the private equity firms or pension fund, and then if I want to look at the stock price, I want to see possibly more than 1 day time period.
Yes.
Even a stock, I mean, forget the exchange rate or other economic forecasting. We let's focus on is a stock market future forecasting.
Yeah. Okay. We only reported 1 day, but we tried 5 day, 7 day, and it's not going to work very well for 30-day forecast because just practically speaking, if you're buying selling stocks, possibly long horizon forecast is always very difficult. We look at the 5 day, which performs slightly worse than 1 day, but still very much. I just didn't put it here, but still within the same ballpark. But anything, for the price movements, usually I don't see lots of people really. I mean, people can technically forecast as long as you want, but do people really, believe, say, 2 weeks, 3 weeks ahead? Because for this type of assets, I guess we've made the assumption that people just accept that prices change quite fast. In the sense that I would expect the price may be different in 2 weeks. Does that make sense?
Yeah.
But if we move on next to, say, sentiment, that's a very legitimate question, because when you have multiple signals coming in, they all move at different pace. In nature, for example, sentiment, you're not going to see the whole market shift, day to day. Then that'll be chaos. So I do think,
Thank you, Maggie.
It's a very, very high frequency and microstructure thing rather than economic forecast model. And yet, so we have another hand, Mason.
Yes, hi. Sorry, it might be loud in the background, but first of all, hi to everyone, and Maggie, hi. And thank you for this. I think it's a very good model. I just have a few questions, and they might be out of place, but I just thought I'd ask because I do work with long short-term memory networks myself. So one of the first questions is long short-term memory networks are used in sequential data. So one of my questions is, does your input include any sequences for the data? Is it of a sequential pattern? That's the first question. And then the second question is, I can see you use performance metrics and you say that long short-term memory networks achieves the lower error rates. Did you also consider including other metrics? Because you say it's lowest error rates, which is something that actually people observe when they use LSTMs. But did you consider using other metrics like precision, recall, and F1 to see the balance of this model? Because when you say lower error rates, that means there's a more balance between the precision recall of the predictions themselves, a better F1 score. So I think that would also be nice to include them. And one other thing, just to a bit build on what Professor Tulu said when he said feature importance in the input, I think he meant also like a set of feature ablation testing where you rerun the model a multiple of times, but with every time you include one feature, because you said, I think you have 5 features. So if you rerun the model every time by excluding one feature, you can see how this, the omitting of this specific feature, whether enhances prediction or enhances reliability of the model. So you can pinpoint which one kind of contributes to enhancing the performance. So that was, I think I just wanted to, because I do that myself. So I just wanted to talk about these things, especially the sequential pattern. Like, do you include sequences and stuff? And thank you.
Yeah. No, thank you. I think, in fact, you, let me say the second point is something that we definitely will need to try. We didn't try this because this is, you know, I guess, in finance, you know, the volatility forecasting, I almost felt it's a forced application, but because everybody in finance wants to do volatility forecasting, and it's so simple that, you know, ultimately we only got one feature in this one dimension, you know, because all different GARCH models, they are the same feature basically. It's the same nature, just volatility to see which one estimating better at the time. But when we move to the other project, when I have different variables, which they are actually real different features, and also sequential points, you're right. So as it's not so much a problem because, you know, it's with one-dimensional time series, the very structured sequential series already. So that's not even, I guess if you're a data scientist, you know, yourself, you won't actually think about that. Again, for this simple one, we didn't use F1, etc., but we do use this machine on, say, more complex financial applications, for example, credit rating. In there, we definitely use, you know, more kind of confusion matrix type based, you know, performance robustness check. So this one, yeah, I mean, in the literature, people also tend to, in the finance literature, forecasting, people tend to use this kind of error based. But yes, we definitely can. Yeah. No, thank you. I think actually you remind me, especially with the F1 score precision recall, that's quite useful. Yeah.
Yeah, so thank you for that. I just wanted you to maybe consider the type 1 and type 2 errors, because when you say low error rates, you would want to see these from the precision of recall. Thank you.
Absolutely. Yeah, definitely.
Thank you. Well done for the moment. I think everybody is clear. Oh, we still have a hand. Jaideep. So you have a question, right? Yeah, please.
Yeah. I just have a quick question about the benchmark itself. So if I understand that correctly, the benchmark is something that's calculated from derivatives. And so is that the right thing to be targeting? Because when you're thinking about a GARCH model and you're forecasting something, you want to use the GARCH model to interpret something, like to use it for like a kind of a portfolio activity or something else. Whereas what I see is you're creating, calculating RMSEs and all on a kind of volatility benchmark, which is implied from derivatives, from my understanding of like what you presented. So if I'm wrong, please correct me. But in that case, the simplest thing to do would be to have as a benchmark to compare against. Instead of GARCH models, you should be looking at the HAR model, which is
yes. I was saying, yeah, okay. Yeah, we do think about that. You know, I think here what we are really trying to show is the use of LSTM. So that's why we didn't do what, you know, the model comparison in the sense of like force racing. So for example, our model against a traditional forecasting model. The student did that in his thesis, but not in this paper. But in this paper, we use this simply because this Bitcoin implied volatility index, T3 index, is kind of like a benchmark that industry use. Just like if you go to stock markets, people will look at the VIX. So, no, but thanks for the suggestion. I think for the academic research purpose, that's definitely something that should be included. But just here we didn't. Yeah.
Thanks. So my point was simply that like the VIX, like in order to forecast the VIX, you use the VIX rather than like GARCH, right? In a sense, or you have to imply you have to sort of think about the risk neutralization that's involved in the VIX. So that's what I mean. So like if you're trying to adapt, you're trying to forecast the VIX with past values of VIX. That's a different exercise than forecasting it with the underlying stock returns. And I think so that's where I wonder if there's a kind of a mismatch. That's what I'm trying to point out.
Yeah, we're basically using GARCH forecasting GARCH volatility, but the forecasting process is done through the LSTM. The implied VIX here is basically as a benchmark to show people, so if you have to say industry benchmark here, you can see our forecasting, where is it relative to what, the market's volatility index is per se. We're not using implied vol here, but I do get what you were saying.
Okay. Thank you.
Yes. And thank you very much for all those questions. Maggie, you worked very hard in explaining everything clearly. And I think everybody has learned a lot through this type of interaction, discussion, so that we can follow you. Maggie, you can continue with your maybe the next part, but shall we keep the time we finish everything within 20 minutes, please?
Yeah, definitely.
Yeah.
I think because we discussed quite a lot, I possibly just skip, all this motivation part. I don't think I need to motivate anymore. So basically, following on the, quite a few questions that we basically want to see all inputs that could affect the volatility. Okay. In finance, we know that the main important thing is that the input has to be observable. That's why we always use prices, and the prices transform to be volatility, blah, blah, blah. Okay, so basically, we also established earlier that sentiment is quite important in this market. We definitely want to see how that affects volatility forecasting. So in this project, what we did is that we basically, in terms of inputs, we try to capture as much as possible signals and put that into the machine. And so typically we obviously is doing volatility forecasting. We keep our GARCH volatility input, and we now just try to see, okay, if we use the option pricing based index calculate based volatility as input, whether that makes difference. And we start to add something that will reflect sentiment in one way or another. So we have volume, which is observable, and we use the Google trend. We also use fear and greed index. That's a particular sentiment index on Bitcoin itself, not the general one. So basically, we can enrich our input. Obviously, we can have output. The question is this middle part, whether it's a machine or it's the AI. There are a lot of debates that AI and machine are different, right? So the machine itself can do a lot of work. Well, some people like to call it black box is fine. But agent is very much have this thinking ability. Okay, so they're very different. But generally what we next want to build is that to have much richer input, and then to see whether there's to try some different possibilities of the machines or agent to get our output. So again, the typical ones we can see are, we tried 3 basically. There are other machines, but we tried 3 that are quite popular. The first one is the convolutional neural network built together with LSTM. The second one is attention as LSTM, and the last one is transformer. The top 2 are machines. So the top one, the big advantage is that it reads the local patterns and then automating the information gathering and then do the forecasting. The second one, attention one, is really to see, whether at the time stamp, they the sentiment, especially when the market there is a sentiment, whether that sentiment, become more dominant, driving the volatility instead of just volatility itself. The transformer itself is agent. It's basically the idea that, we have all the information and it acts like a person to extract intelligence, learn from that. So we will have a quick look at all of them. I've already mentioned about the data input here. I'll skip that. So basically, the first one we tried is this convolutional neural network. What we did is that we add in this sentiment machine in between with this structure. The convolutional layer basically is looking at the local patterns. So what it looks is trying to extract patterns locally from historical information. So for example, if I look back the last 7 days of the information, and do I drag the pattern, then whether this pattern actually really affect my volatility forecasting. How do I say? Okay, so at time T today, I observe markets, either any of those inputs, either the volatility or sentiment indicator is, let's say, it's a bit high. And then the convolution layer is going back the history to try to find similar features in history and to identify similar patterns. For example, if I look back about 30 days and find, like I say, day 24, that's, sentiment or one of the features from my input is raised, and that could be the pattern, could be the reason leading to today's observation of, say, raise the volatility or raise the sentiment signals. And then it would extract the pattern and does this calculation. And then obviously here, the max pooling layer is pretty much tidy up the pattern learning outcome from the convolutional layer and then consolidate that. Then exit as input, new input into the LSTM, and then does the automated forecasting, like what I explained in the first project. So the second structure or architecture we tried is, instead of looking at the local pattern, what we did is that at the time you look at today, for example, today's markets, you have all different features indicating a picture. Then let's say today either the volatility or sentiment increase. Then this attention layer is going back to look which of the features in the past, for example, 7 to 30 days, start to show similar pattern. And then I further amplify that factor. So for example, today I realize the volatility is a bit higher, and I go, and then this attention layer goes back to history to find day 24 again. All other features are following the historical pattern, but, like a Google trend, doubled. So I can very much decide, the attention layer decide, okay, it's more likely because the Google trend search inflated at day 24 that caused today. So that's the attention amplifying effect. So I further going to amplify that particular feature that showed the potential of the rise of the raise, and then use that as a new in, amplify that particular factor, then update my input and put it into the machine for my forecasting. So the mechanism is slightly different. So the previous one is to looking at the overall pattern, local patterns, and this one we just discussed here, the attention layer, is to looking particularly for where the tension is causing that amplification. And then we have the final one, which is a transformer. It's basically, all my entire history is a block of information there. And the self-attention layer coming from the transformer is acting as a normal person, thinking, reading all the information, all ideas in the transformer unit, in the layer unit itself, it goes through all possibility. It's more kind of search entire inference. Somebody mentioned the Bayesian search. It's kind of that kind of design. And then it figure out where is the amplifying starting. Okay, then use that as a new input, and it goes through the transformer's own intelligence unit. I wouldn't call it machine, because the whole idea here is that the transformer itself has some kind of human-like intelligence. So I wouldn't call it machine. So this is the third structure we tried. The data itself, again, we use the daily closing price, but this time we added the trading volume, and we input the benchmark. Basically here is a multi-input kind of machine. And we have fear and greed index. We also have our Google Trend search as well. So we want to see how different things are doing. So this is, again, the visualization for the results. What you can see here is, the attention LSTM, that's the purple one. It's possibly, the red one, first of all, is our adjusted attention LSTM. I'll explain that in a minute, but that's possibly the best one fitted. How can I explain this? Let me just show this, and then we possibly go back. That makes more sense. But basically, we had attention LSTM, we had the convolutional, and we have transformer, and we have the original one, which doesn't include sentiment. You can see the estimation, the process check, that the attention machine seem to perform better. So the local pattern-based architecture isn't the best. The transformer, which is supposed, in theory, we think AI, right, it has intelligence. We were expecting it to be the best performer, but it's actually not. But this attention one turned out to be the better one. That's the 1 day or 5 day. But we further did a little bit, one big adjustment, because the original attention layer is just to that attention layer to go back to look at all 5 input features. Well, we did a little bit adjustment just for experiment to see whether that helps or not, because the whole point here is that we know sentiment has impact. We want to really capture the impact of the sentiment. So what we did is, in the attention layer, instead of ask the attention layer to go back to look at all inputs, we asked the attention layer we added in an indicator called Google Trend. We use Google Trend volume combined. So we basically asked the attention layer, first of all, to look at the Google Trend volume. If we identify Google Trend and volume at the same time, indicating the rise, so that's indication of sentiment enhanced. So we basically added in a sentiment indicator here. We ask the attention layer to detect the sentiment indicator first. If that indicator is indeed, increased, then the attention layer will go back to amplify the fear index. So we're basically saying, okay, we're sure it's a sentiment affecting the volatility now, and we want to give a little bit more amplification on sentiment. And obviously, the machine itself will learn from the information to decide the weights. We'll assign the higher weights to the fear and greed index. And we ran the whole machine. It turned out to be even better. Ooh, sorry. You can see that when we just do a little bit adjustment to improve the machine structure, and you see slightly better. But just through all this, all these exercises, we get a few things. So first of all, we confirm that sentiment does matter. It does affect volatility forecasting, especially in the market like Bitcoin, which the market structure is very much like market microstructure. The second thing is that the sentiment volatility model architecture really would matter how you design your machines or your agents. The third one is that adjust the attention LSTM machine. In our view, it's between a machine and agent. It's almost like a semi-intelligent agent, because when you have attention, you already let the machine kind of think, although you set a rule, but you set a rule and let the machine think more like a person, but it's not completely autonomous kind of thinking style yet. But obviously this type of work have a lot of, limitation, and there's still a lot of, hidden things in each layer. Whenever you do a machine, you add a layer, there's a lot of inexplainability, and your machines don't always work, and it could work for a while, and then the shelf life is gone, and then, your machine break down, that kind of thing. And again, there could be a lot more. We can experiment on how we, find the sentiment signals, and also the fundamental debates whether the fear greed index or Google search, are they really the accurate sentiment, indicators or not? So in the future, there are also, things we can do by applying different new techniques. For example, especially in the AI area, the real agents that have thinkability. So as I said here, Transformer is a popular, possibly early agent. And for tasks like the volatility forecasting, it's not performing very well, because really comparing to a lot of applications, say in biochemistry, we're actually, in finance, we're not dealing with that big data case. So sometimes, I think it's a little bit overkill. And also, there's debate of, if you design AI agents, will we go complete towards to say agentic AI, which is an autonomous system that without human intervention, or you're actually going to use agents to be a assisting tool, and you still will have, say, your fund manager at the end, or the analyst at the end, to make the final decision. Yeah. So I think, to answer the question, will sentiment models, catch the hype of AI or this kind of large language models? I think it really depends your problem and the data structure complexity, and really your needs. So I wouldn't suggest we all just, kind of rush into use AI models. That's all.
Wow, thank you. Yeah, but the application of this AI and machine learning things is very popular. It's probably in finance is one of the most popular area, I would say. So we will see them. And Maggie, can I ask you to go back to your second model, the benchmark model for your multivariate second model? And I will kick off a couple of questions, and then maybe we have some more questions.
You mean the attention one?
Yeah, the extension one, the benchmark one. Go back, maybe one more. And those are the three things. I need the benchmark one. Go one more back. Yeah, this one. No, the next one. Sorry.
The input.
Yeah. So this model, I'm more convinced by this model because now you introduce the multi-factors into the original input.
Yeah.
And then another addition is in your second stage, you actually added another layer of machine thing. I don't know what is that, but you added a layer to work on those original, the multivariate, factors. And then you get some input, you get some results, and to add the input to your forecasting program machine. So I have two questions. One is you added those multivariate factors. How do you decide which one that you added in? Why Google search? Why not VAX? I missed maybe. Do you have VAX here? So for example, this is just an example. Why do you choose those 5 rather than 6, 8? That's one question. So my second question, and that is another decision that you make, and that is in this second stage, machine intelligent stage, you added something, and in your presentation, you added 3 aspects. So one is the local thing, local pattern. Second is probably the call movement or evolution. And the third one is transformation. So how you decide which one that you use? Why did you choose those 3 things? And whether or not you have more. So that's basically my question based on this benchmark extended model.
Yeah, okay. So first of all, this data input, I don't choose a stage. I put all of them in. And there could be other inputs. These are basically here we just chose, because we want to see volatility and sentiment. So we just chose some input that will reflect volatility. And that's input, that's model, that indicates sentiment. So with the volatility, obviously, we did the first project. We used the GARCH. That's just typical one we use. And then the IVX, I have to say it's convenient. You could vary them. So for example, if you in your work you did say you use the realized volatility, you could use that as input. That's you can decide based on your needs. With the sentiment, we basically picked all popularly available kind of indicator. So volume itself, possibly some people don't think it's a sentiment indicator, but the volume does tell you kind of trading size related features. So it's kind of remotely hints something about sentiment. It could also be, for very liquid asset like Bitcoin, it could be very, the change in volume could be very static because every day there's a lot of volume anyway. Google Trend is the Google search, particularly focusing on Bitcoin as a keyword. So that's a lot of papers or a lot of practitioners use. And the fear and greed index on Bitcoin is, especially in the crypto currency area, it's more and more deemed to be if you talk about crypto sentiment, everybody will just have a look at this. So, again, with input side, this type of application is very data based. You can vary your input. You can add in more. So for example, some people may add in some, say, analysts forecasting, indicators that could do, and we just didn't. Yeah. In terms of the machine, those three are three different architecture. Maybe. We are trying each and then see which would be better. Okay. So the first one is very much focusing on extracting local patterns by considering all the inputs at the same time. The second one is very much to look at, you know, the where attention is. You know, you have this set of inputs, but which is the attention, you know, where the attention from input is coming from, that would influence the forecasting. The transformer thing is, again, this is very early AI agent. We so far we haven't really looked at others because it's first one and everybody's using it. We just want to see whether this kind of intelligent tools, agents would work or not. Before we used transformer, we knew it may not work because really, you know, we're using daily data. And even we use 5 different inputs, but they are all very structured. They're all like a time series, and, you know, the timestamps can all be aligned and they can all be processed into numerical data. So, you know, it may be better if your problem is very complex. The data inputs are very different, you know, the different types. I think that would work much better.
Yeah. And so, Maggie, my following up question is, so did you did you modify any programs, or did you take, you said those are the infrastructure. So did you take the existing infrastructure, or did you design anything in this intelligent stage?
No, we basically use the standard. The only thing we did is we ran 3 standards. So the basic, for example, the you know, like those cell structure of the machines, we didn't really change. We used the basic standard. We didn't write up, for example, in any of the machines, we didn't write up activators, or we didn't code the new ones. But the only thing is this enhanced one for the attention one. As I said, we basically just tweak the architecture of the attention layer a little bit. Instead of looking at all inputs, we ask the attention layer to also, you know, read the signals from the Google trend and volume combined.
So I understand. So it's all about data availability on your input side, and the machine side is the availability of the infrastructure. And you can do something maybe, but limited probably for the moment.
Yeah, I would say us as, you know, people who are focusing on applications, we're more concerned about whether the design is more like, I'm more concerned about I design a model that, you know, will coincide with how a person think about this or use this. I'm not even designing from, say, computer scientist perspective. So it's more from user perspective.
I understand. Okay. So Jaideep, come in, please.
Sorry. So I have a slightly pedantic question. I just wanted to check. You mentioned timestamp, but I was wondering. So you use daily data. So does that mean that we can get like Google Trend data in time on a daily basis?
Yes, you can. That's why, you know, the input. As I said, we can obviously have a more complicated thing, but we are trying to get at least they have, you know, like they're all sequential, for example, because when you have multiple inputs, you have to align them as well. Yeah, you do. So, like, especially, I think, volume definitely is time varying. All these, Google Trend, you can't have daily counts. Yeah. And
I mean, because I wasn't sure that they publish it on a daily basis, that they update it the same day.
They do. We took. I do get what you're saying. You know, sometimes they publish update every day. We did collect them for the sample period.
Okay, okay, I understand. Thank you.
You possibly could, because when we did the actual experiment, obviously this is database, you can read the data features. And even you take Google Trend, it's okay. Even in the just attention layer, the volume and the Google Trend pretty much coincide quite a lot. So what really capturing, carrying useful sentiment information is the fear and the greed index. Because if you look at Google Trend, even we collect data, we plot it, there are a lot of static periods. But fear and greed index, again, they not only based on, counts of mentions, they also have other factors contributing to it. But also, what I realized is that fear and greed index, I think recently, they couldn't update this, or they still update this, but they actually took out the elements of the online survey. So, for example, they have multiple elements that to construct this index. One is online survey, for example, about Bitcoin. They actually didn't get the update on the online survey data. So, in the newest, possibly most recent last few months, when they update fear and greed index, that index is calculated without online survey component. Yeah, that will also affect, your estimation.
Yeah. Any other questions? Do we have any other questions or comments? Okay. So if not, I think, Maggie, we have learned a lot today. And for people who are basically out of this machine learning things, we do have some colleagues who worked more closely on this. But in terms of the application, we understand more about how we can understand the application of AI and machine learning models in actually in forecasting financial volatilities. And you used this cryptocurrency market as an example, but I think the logic can be applied to other element of capital market as well. Maybe keeping in mind that this market, the crypto market, is more, to me, is more sentimental, is more volatile, is of higher uncertainty as compared to other part of the capital market. So I think probably it's more speculative rather than, using the market to hedge or et cetera, et cetera. So and that's my understanding. And we got some good questions. And thank you so much for your very patient explanations to us. And so I saw some hands. Maggie, do you have one sentence to before I close?
Oh, no, I just want to say thank you. And thank you for being interested and asking so many questions. That's actually the best thing to get from seminar. Thank you.
Yeah, thank you so much, Maggie. Thanks for your support to our seminar. We will keep in touch. We'll keep in touch. Okay, thanks a lot for people and for your patience and for your contribution to the discussion. So I will see you next week.